Welcome to another video. Today we are going to be talking about risk management primarily. And I'm going to be discussing how you can manage your risk, how you can trade efficiently, regardless of how much you have in your trading account. All right, so here we have John. This here is John. Now, John has a $5,000 account, all right, and he looks forward to trading the financial market with what he has. Now, John, just like everyone else, wants to enjoy the benefits of trading the fluctuations of the market. But John is someone who has quite a lot of money in his bank account. All right, so he has at least 10 times the amount of money that he wants to trade. So he's trading a $5,000 account, but in his bank account, he has about $50,000. This is one of the most important things you need to know as a trader. When you are trading, the first concern when it has to do with risk management is that you have enough money in the bank, at least 10 times. Sometimes if you are okay with risking a lot more, maybe John in this case might be a conservative trader and doesn't want to expose himself to too much risk. You might be willing to take that much risk, but at least have some money in your bank account and you just put everything into your trading account. So this is John. He has $50,000 in his bank account, and then in his trading account, he looks forward to trading a $5,000 account. Now, John wants to risk 1% of his account on a single trade. Now, what that means is that John has the tendency of taking 100 trades. Now, if you divide 5,000 by 50, you will notice that you can get 100 trades if John has to risk $50 on a single trade. Now, one of the things that you'll be able to look at, or one of the things that you will notice about John is that much more than having some money in his account, which is his bank account, he also is very conservative with the amount of money that he has in his trading account. So he's not risking $1,000 on a single trade. He's risking $50 on a single trade. What that means is that John can take about 100 trades, and even if the first 50 trades end in a loss, John still has the possibility of continuing to trade because he's risking minimally just 1% of his trading account. Now, before John begins to trade, there are certain things that he has to consider. He has to consider his trading strategy. Does he have a good trading strategy? Does he have a wonderful win rate? And does he know his risk to reward ratio? These are the things you have to consider as a trader. What is your trading strategy? Where am I going to buy? Where am I going to sell? At what point should I wait for the market to give me an opportunity to buy or to sell? You have to understand this well enough. You have to have a trading strategy before you get into trading. Before you even consider risk management, you need to have a trading strategy. And then you need to know your win rate. How many times do you win in a trade? All right. You need to also know the risk to the reward ratio. Now, when we talk about win rates, we are going to be looking at the chart shortly so that I can explain to you how you can manage risk in the case of John. Now, you can also bring this illustration into your own trading account. And some of you might be watching this video, you don't have as much as $5,000 in your trading account, but at least you are probably $500 and $1,000 or lesser. Just use this illustration, this that I'm able to figure out your way around risk management. This risk management is not as difficult as many people make it seem. It's just all about doing the little calculations that is part of our basic life. Now, when we talk about win rate, how often you win a trade, all right, often in percentage. Now, your win rate is usually connoted in percentage. All right. So if you have 15 trades, let's say in a month you take 15 trades. Now, in having 15 trades and then having a 40% win rate means that you are going to win 66 times out of 15. So what that means is that you are going to lose 11 times and then win 6 times. Now, having a 40% win rate is not static over the months. All right. So in January, you can have a 40% win rate. In February, you can have a 50% win rate. In March, you can have maybe 35% win rate. It's usually not constant. You can always have, your win rates constant all the while. All right. But you can average on, in a period of 6 months, you can know this is my average win rate. Now, this win rate is not to get you scared. All right. Some people will be like, wow, will I lose 11 trades just like that? I believe the win rate is too small. That should increase my win rate. Now, the truth about trading is that it doesn't really matter the win rates that you have. Yeah, it doesn't really matter the win rate you have as long as your risk reward ratio is in place. All right. The only time you begin to wonder or you begin to bother about your win rate is when you notice that you do not have a good risk reward ratio, right? That's when you know you are going to fall short of profitability. Now, let's say you took 15 trades in a month and you have a 30% win rate. That means you are going to be winning 6 trades out of 15. Now, let's do the little and simple calculation. You know, so many people are wondering, how am I coming up with 6 trades out of 15? How do you do the calculation? All right, so let's just do the very simple calculation. It's a very simple calculation. All right, so we have here, we have 15 trades and then 40%. It's just that simple, right? 15 times 40% will give you 6. Just as easy as that. 15 times 40 will give you 6. All right. So we have 6 trades out of 15. So that's how you find out. That's how you find out the amount of trades you are likely to win based on your win rate. Now, let's say we have 50 trades, all right, and you have a 30% win rate. What will your number of trades, your winning trades, what will it be like? All right, you can take your time, do your calculation, and we'll get back to the answer. All right, but before then, let's look at trading strategy. Right, please do your calculation and then you put it down in the comment below if you're able to get it before we continue this video. So let's go straight to the trading strategy. Remember, we talked about trading strategy and then we talked about the win rate. So let's go to the trading strategy. Let's say John has a simple trading strategy, right? So let's say this is John's strategy. Now let's look at this chart a little bit. So we look at this. Now, John's strategy is a simple one. Now, I know that you may have your own trading strategy. Everybody has their own trading strategy, right? So let's say John has a very simple strategy. His strategy is just buying the trend, all right? So he's looking forward to taking trades after a break of structure and then the market returning to an area of interest and then he wants to buy. So John's strategy is easy. All he looks forward for is he wants to look for a break of structure. And then once he notices that there is a break of structure, that means that the market will push higher. So it draws a Fibonacci level from that point to that point right there. All right. Now, what John is looking forward for is he wants to look towards buying at this area. This is his trading strategy. He wants to look towards buying at the middle of 50% level and 61.11. So he puts his order right there. That's where he wants to buy. And then the stop loss is at the middle of 78 to 100 Fibonacci level. So that's where he wants his stop loss to be. And then he targets the risk reward ratio of 1 to 3. All right, so this is a risk reward ratio of 1 to 3. Now, this is John's strategy. Now, remember, we talked about the win rate. So what this means is out of 15 trades that John might take, he will likely win 6 of them. All right. Now, it's possible that John can win 9 of them, 10 of them. All right. But for John to be in the best psychological state of mind, it is better for him to have a lower expectation. You see, when you have high expectation, there's a tendency for you to feel so terrible when your expectations are not met. But if you lower your standard, if you lower your expectation, there is a tendency that even if things don't go as planned, you're already expecting it in the first place. So there is no so much psychological pain with respect to your losing, consistently, or losing 3 trades in a row, losing 4 trades in a row. So now let's look at the chart. Since we have been able to figure out John's strategy, let's look at the chart if we had an opportunity just like that. All right. So we see in this case now, we notice that there was a break of structure internally at this point here. All right. Now I may not be able to do it very, very clearly or very well, but I hope you understand what I mean. You should have your own trading strategy. If you're watching this video and you don't have a trading strategy, hopefully in the coming weeks, coming days, I will create some videos on trading strategies that you can actually make use of. All right, so we see from this point here to the high right there. All right, so what do you notice? We broke structure at that point, the market pushed higher and then came back into 50 and 61 level. What do we see? We want to buy at that point. So I take my long position. I want to take my long position. So where okay. Give me a while. I think I'm having a lagging system. So you see, we want to go long from here, the middle of the middle of this point right there. Then target a risk reward ratio of 1 to 3. All right, so that's what we are looking forward to do. All right, now this is John's own strategy, not your strategy. All right, but if you choose to use John's strategy for your own personal strategy, that's fine too. All right, so you see that the market came to that point, and then we start seeing that push to the high side, even though the target has not been met. But John is expecting to take his profits at that point. All right, now let's go back to the net. Let's see if there's yet another opportunity that we could seize from. All right, so we see yet another somewhere around here. We see that the market breaks structure slightly up there. All right, so many people may not make use of weak as a break of structure, so this can be valid as a break of structure right there. All right, so we see that break of structure. Now, what do? We draw our Fibonacci level from the point down here to the high. All right, now what do? We want to take our long position from 68, which is somewhere around there. Now, stop loss will be below that space right there. Below. and then we target risk reward ratio of 1 to 3. So we see that the market came to that point, all right, and went straight to the risk reward ratio. All right, so